Remember 2008? It felt like the world's entire financial system just stopped, went into cardiac arrest. A lot of us lived through it, right? We saw the headlines, we felt that anxiety in the air. But what was really going on behind all that jargon of subprime loans and credit default swaps? Well, today, we're going to pull back the curtain on an event that wasn't just some accident, it was an engineered catastrophe. Let's get into it. And that right there, that sentence just cuts right to the heart of it. This wasn't a natural disaster, This was man-made. It was a demolition of trust, a demolition of the economy, and maybe most of all, a demolition of the idea that anyone was actually minding the store. So what do we mean by a controlled demolition? We're really talking about a systemic betrayal. This wasn't just a slip-up or a miscalculation. Nope. This was a crisis that was carefully built over years, and it had devastating real-world consequences for ordinary people. And this is the core injustice that makes the whole story so infuriating. For millions of people, the American dream just evaporated. It turned into a nightmare of foreclosure signs on lawns and retirement funds that were suddenly gone. But the folks who lit the fuse, they didn't just survive, they profited big time. We're talking multi-million-dollar bonuses, golden parachutes. They literally bet against the very garbage they were selling to the public. They walked away from the ruins they created richer than ever. So how in the world did they pull this off? Well, to get it, you've got to understand the machine they built. It was a brilliant but terrifying machine designed to do one thing: turn the simple idea of homeownership into a global casino. It was a financial time bomb, just ticking away, right at the heart of the world economy. And here's the really sneaky part. On the surface, the idea seems kind of smart. A mortgage-backed security, an MBS, is basically just thousands of individual home loans all bundled together into what looks like a super safe, reliable bond. And this financial product, this was the fuel for the entire fire. Okay, but a machine like that needs constant fuel, right? It needed more and more and more mortgages to keep going. So when the banks ran out of good, qualified buyers, they just started lowering their standards, all the way to the bottom. They invented subprime loans, basically toxic sludge knowingly given to people who had no real chance of paying them back. This was the poison, and they were injecting it right into the bloodstream of the global financial system. You'd think that's as bad as it gets, but oh no, the story gets even darker. Because it wasn't enough to just sell this toxic stuff. Wall Street figured out a way to get rich when it all inevitably blew up. They called them credit default swaps. Now, what is that? Look, think of it this way. It's like buying fire insurance on your neighbor's house and then secretly hoping it burns to the ground. These weren't investments, they were side bets, a multi-trillion-dollar shadow casino that was all gambling on total financial ruin. So you've got to be asking, right? Where were the regulators in all this? The watchdogs? Anyone? Well, they were in on it. The big rating agencies were getting paid millions by the very banks they were supposed to be rating. So they just stamped these bundles of toxic debt with perfect AAA ratings. It was a fatal conflict of interest. But hey, everyone was getting rich, and nobody wanted to be the one to stop the party. Well, as we all know, every party has to end. And when the music finally stopped in 2008, the dominoes didn't just fall, they crashed down with a speed and a violence that nobody seemed to see coming, even though a lot of people had been quietly preparing for it. And man, when it happened fast, terrifyingly fast. In just a handful of days, these massive century-old pillars of the financial world just vanished. Or they were put on life support by the government. That Lehman Brothers bankruptcy on September 15th, that was the moment. That was when everyone all at once realized the system wasn't just cracked, it was completely and utterly broken. And the fallout, the level of wealth destruction is just staggering. It's almost impossible to really wrap your head around. Look at that number, over $19 trillion. That's not just a statistic on a screen. That was people's lives. That's retirements gone forever, college funds totally wiped out, and family homes lost. So obviously, with the whole system on the brink of collapse, the government had to step in. But the big question became, who are they really here to save? The answer turned out to be a really bitter pill for most people to swallow. And the difference between what happened on Wall Street versus Main Street, it couldn't be more stark. Trillions of our dollars, taxpayer dollars, were funneled into the very banks that caused the whole mess. Some of their executives even used that bailout money to pay themselves bonuses. Meanwhile, out on Main Street, people were facing foreclosure and unemployment with basically no help at all. The bottom line, the system was saved. The people, not so much. So, when you look back at all this, it wasn't just a failure of spreadsheets and fancy algorithms. It was a profound moral failure. For a lot of people, this was the moment they realized the system wasn't built for them. It was built to protect itself, no matter the cost. But believe it or not, the story doesn't end in 2008, not by a long shot. Because the so-called solution to the crisis, it pretty much paved the way for all the economic weirdness and instability we're dealing with right now. The main tool they used was something with a really fancy name, quantitative easing, or QE for short. But don't let the name fool you. It basically means one thing: creating trillions of dollars out of thin air and pumping it directly into the financial markets. The goal was to keep asset prices high and interest rates low. And if you want to know who that helped, well, this chart tells the whole story. The stock market went on a tear. Corporate profits exploded. It was an incredible decade if you owned assets. But for the average worker, we just barely moved. It basically poured gasoline on the fire of the wealth gap. So then, fast forward to 2020, the pandemic hits. And what do the policymakers do? They pull out the 2008 playbook and just put it on steroids. Everything was faster, bigger, and even more direct. They perfected the model of just massive intervention. And that leads directly to the inflation and the instability we're all trying to navigate right now. Okay, so after all that, what are we supposed to take away from this? Well, there are three really big lessons here. First, if a financial product sounds way too complex to understand, it's probably designed that way on purpose, to hide the risk. Second, when you bail out bad behavior without any consequences, you pretty much guarantee it's going to happen again, only bigger next time. And lesson three, you have to understand this stuff. Financial education isn't some luxury, it's straight up self-defense in the world we live in now. Which brings us to some tough questions, doesn't it? First up, who actually benefits from a system that privatizes all the profits, but socializes all the losses? And when it all goes south again, and it will, who's left holding the bag? Who ultimately pays the price when Wall Street decides to gamble? Because the music always stops. The deep fundamental problems that we saw in 2008, they were never really fixed. They were just buried under a mountain of new money. So what happens next time? And that right there is why understanding what happened in 2008 is so incredibly important. It wasn't just some event that happened in the past. It was a warning. Because the system won't warn you, and the headlines won't save you. But history will teach you everything you need to know. You just have to be willing to listen.